Here's something wild that'll grab your attention right away. A stock that was trading at 50 cents just a few months ago is now sitting at over $8. That's more than a 1,500% gain this year. I'm talking about Opendoor Technologies, and today I'm walking you through my complete analysis to see if this rocket ship still has fuel left. What Opendoor actually does. Let me break this down super simple. You know how selling a house is usually a nightmare? You find a realtor, stage your home, deal with showings, negotiate with buyers, and pray nothing falls through. Opendoor basically said, forget all that chaos. Here's their game plan. They use AI and data to make you an instant cash offer on your house. You like it? Boom, they buy it. No waiting months for the perfect buyer. They fix it up, then sell it to someone else. Think of them as the Amazon of real estate. They're trying to make buying and selling homes as easy as ordering a book online. Pretty cool concept, right? But here's where it gets interesting and complicated. The roller coaster ride. This stock has been on more ups and downs than a theme park. Let me paint you the picture. Back in 2021, during the housing boom, Opendoor was flying high. Everyone wanted to buy houses. Interest rates were basically zero, and their model was printing money. Then, 2022 happened. Interest rates shot up faster than a rocket. Suddenly, nobody wanted to buy houses anymore. Opendoor got stuck holding thousands of homes they couldn't sell. Imagine buying a bunch of inventory and then the whole market just stopped wanting what you're selling. The stock crashed from over $25 to under $1. We're talking about a company that lost over 95% of its value. People wrote them off as dead. The Fed factor, why this matters right now. Here's where the current market gets really interesting. The Federal Reserve just cut interest rates for the first time this year in September 2025. You'd think this would be amazing for housing companies like Opendoor, right? Well, it's complicated. When the Fed cuts rates, mortgage rates usually follow. Lower mortgage rates mean more people can afford to buy homes. More buyers means Opendoor can sell their inventory faster and at better prices. But here's the catch. Mortgage rates didn't drop as much as everyone hoped. They're still sitting around 6.35%, which is way higher than the 3% we saw during the pandemic. Plus, home prices are still at record highs. So, even with rate cuts, housing affordability is still brutal for most people. Think of it like this. If a burger costs $20 and they give you a 10% discount, it's still an expensive burger. That's where we are with housing right now. The numbers that matter. Let me walk you through what Opendoor actually delivered in their latest quarter. This is where things get really interesting. They brought in $1.6 billion in revenue in Q2 2025. That's up 4% from last year and 36% from the previous quarter. They sold 4,299 homes. But here's the kicker. They made their first profit in 3 years. Not a huge profit, but profit nonetheless. Their adjusted EBITDA was $23 million positive. For a company that was bleeding money just quarters ago, this is huge. It shows they're finally getting their costs under control and their pricing right. But let's be real about the challenges. They're still sitting on $1.5 billion worth of houses in inventory. That's 4,538 homes they own but haven't sold yet. In a slow housing market, that's like having a warehouse full of ice cream during a blizzard. The leadership shakeup. Here's where the story gets really spicy. The old CEO got pushed out after a brutal pressure campaign from investors. You see where this is going. In September, they brought in Kazaz Neji-Chan as the new CEO. This guy was the COO at Shopify, the company that basically powers half of the online stores you shop at. He knows how to scale digital platforms and make them profitable. But wait, there's more. The company's co-founder, Keith Rabos, came back as chairman. This is the same guy who helped build PayPal with Elon Musk and Peter Thiel. He's got serious tech credibility. Rabos isn't messing around either. He said the company has 1,400 employees and they only need 200. That's an 85% workforce cut he's planning. Brutal? Yes. Necessary for profitability? Probably. The meme stock phenomenon. Here's something you need to understand about this stock. It became what people call a meme stock this year. That means retail investors on social media started hyping it up and buying it in massive quantities. A hedge fund manager named Eric Jackson started promoting it on Twitter, and boom, the stock went parabolic. We're talking about moves that make no sense based on fundamentals alone. The good news is, all this attention brought in new investors and gave the company a market cap of over $6 billion. The bad news is, meme stocks are volatile as hell. What goes up fast can come down just as fast. What the experts are saying. This is where it gets really interesting. Wall Street analysts are not buying the hype at all. The average price target from analysts is $1.45. The stock is trading at over $8. That means they think it's going to fall more than 80%. Ouch! Most analysts have a sell rating on the stock. They're basically saying this party is going to end badly. But here's the thing about analysts. They're often wrong about turnaround stories. They said Amazon was overvalued at $100. They said Tesla would never be profitable. Sometimes the market sees something before the experts do. Rate cuts and real estate, the bigger picture. Let's zoom out and think about where real estate is heading. The Fed cutting rates is step one, but we need more cuts to really juice the housing market. Here's what lower rates could mean for Opendoor. First, more buyers come back to the market. Second, they can sell their inventory faster. Third, they might be able to expand to new markets without as much risk. But here's a catch. Lower rates also bring more competition. More buyers means higher home prices, which means Opendoor has to pay more for the houses they buy. It's a double-edged sword. The housing market is also dealing with a massive supply shortage. We're short millions of homes in America. That keeps prices high, even if demand is soft. For Opendoor, this could be good. Limited supply means they can charge premium prices for the homes they sell. Short versus long-term play. If you're thinking short-term, this stock is pure gambling. The meme stock momentum could fade tomorrow. Quarterly results could disappoint. Interest rates could go back up. There are a million ways this could go wrong in the next few months. But long-term, that's where it gets interesting. If Opendoor can prove their model works, if they can stay profitable, if the housing market recovers, this could be massive. Think about it. They're trying to digitize the biggest purchase most people ever make. If they crack that code, we're talking about a $1 trillion market opportunity. Entry points and strategy. Here's how I'd think about playing this if I were considering it. And remember, this is high-risk, high-reward territory. For short-term traders, you're basically betting on momentum. Watch for any positive news about rate cuts, housing market improvements, or company milestones. But set tight stop losses because this thing can move 20% in either direction on any given day. For medium-term investors, wait for a pullback. This stock has gained over 1,500% this year. Something that goes up that fast usually takes a breather. Look for entry points around $5 to $6 if it pulls back. For long-term investors, you're betting on the transformation of real estate. If you believe houses will be bought and sold online in the future, Opendoor could be the Amazon of that space, but you need nerves of steel and money you can afford to lose. The bottom line. Here's my take after diving deep into all this data. Opendoor is at a critical inflection point. They've got new leadership, they're finally profitable, and interest rate cuts could be a tailwind. But this is not a stock for everyone. The analysts hate it, the valuation is sky high, and it could easily lose 50% of its value if the housing market doesn't cooperate or if meme stock enthusiasm fades. If you're going to play this, treat it like a lottery ticket with better odds. Don't bet the farm. Maybe 1–2% of your portfolio max, and be ready for a wild ride. The transformation of real estate is coming whether Opendoor leads it or not. The question is whether they can execute better than their competitors and whether the current stock price gives you a good risk-reward setup. That's the real opportunity here. Not just a meme stock pump, but potentially getting in early on the digitization of America's biggest market. Just make sure you can handle the volatility along the way. Remember, in investing, it's not about being right or wrong. It's about managing risk and position sizing. This stock could be a home run or a strikeout. size your bet accordingly.